Hello everyone. In this module, we are going to discuss about the meaning of depreciation, its definition, causes, objectives for calculating depreciation, its methods, a short explanation on diminishing balance method and unity method, and two example sums on these methods. Let us first discuss the meaning of depreciation. Depreciation is a permanent decline in the value of the asset. The gradual decrease both in the value and usefulness of an asset due to its nature and usage is termed as depreciation. So, it is a common experience that whenever an asset is used, it reduces in value. The net result of depreciation is that sooner or later the asset becomes useless. So, here are a few examples: machinery, furniture, building, etc. Causes of depreciation. Causes for depreciation can be classified into two types: internal causes and external causes. Wear and tear, exhaustion, depletion, deterioration comes under internal causes. Under external causes, we can see affliction of time, obsolescence, weather and natural calamities, permanent fall in market value of asset. Wear and tear occurs due to the complete use of an asset. Exhaustion. When an asset is used for a particular period of time, it gets exhausted. Depletion. Assets which get exhausted and are involved in mines, quarries, and oil fields, forests, etc., are called as depletion. Deterioration. Deterioration is the process of getting completely worse. Under external causes, affliction of time. Assets such as lease, copyright, patent, etc. have a fixed number of years of legal life, after the expiry of which they are rendered useless. As such, their cost is written off over their legal life, and the amount charged against revenue every year is known as depreciation. Obsolescence. Loss of usefulness occasioned by improved production methods is known as obsolescence. For example, an old machine which is still workable may have to be replaced by a new one because the latter may be more efficient and economical. Weather and natural calamities. Some assets lose in value when they are constantly exposed to rain, sun, wind, etc. And certain assets decline in value when they are affected by certain natural calamities like flood, earthquake, fire, etc. Permanent fall in market value of an asset. Generally, we do not record fluctuations in the market price of the fixed assets in the books. However, if the fall in market price is permanent, it is accounted, which leads to a fall in the value of fixed assets in the books. Next, let's discuss about the objectives or necessity for providing depreciation. Ascertainment of true profits. When a particular asset is used for earning income of a business, the reduction in the value of the asset should be provided from the income in order to calculate the correct and real income of the business. Presentation of true financial position. If depreciation is not provided for, the balance sheet will not disclose a true and fair view of the firm's state of affairs, etc., since the assets will be shown at different figures which are in excess of their true value. Replacement. The amounts debited in the profit and loss account are retained in the business. These are available for replacement of the asset when its life is over. So, by making an annual charge for depreciation, a concern would be accumulating enough resources to enable it to replace an asset when necessary. No distortion of divisible profits. If depreciation is not charged to profits, trading results are vitiated and divisible profits are distorted. Here are few methods for calculating depreciation. They are straight line method, written down value method, sum of years of digit method, annuity method, sinking fund method, machine hour rate method, production units method, depletion method. So, here we are going to discuss about written down value method and annuity method. Let us first understand what is diminishing balance method. According to the diminishing balance method, depreciation is charged at a fixed percentage on the book value of the asset. As the book value reduces every year, it is also known as reducing balance method or written down value method. Thus, this method tends to offset the amount of depreciation on one hand and repairs and maintenance on other hand. This method is suitable in case of those assets whose repair charges increase as they become old. For example, machinery. Next comes annuity method. The annuity method of depreciation is also referred to as the compound interest method. If the cash flow of the asset being constant over the life of the asset, then it is said to be annuity method. It is important to note that under the annuity method, the cost of the asset as also the interest thereon are written down annually by equal installments until the book value of the asset in question is reduced either to zero or its residual value at the end of its usefulness to the business. The amount of depreciation is found out from the annuity tables. Examples make statements clearer and decrease the chances that the fact or idea to be wrongly applied to the given situations. So here I have attached two example sums, one each on diminishing balance method and annuity method. First, let us discuss a sum on diminishing balance method. A company whose accounting year is the calendar year purchased on 1st January 1993 a machine for Rs 40,000. It purchased further machinery on 1st October 1993 for Rs 20,000 and on 1st July 1994 for Rs 10,000. On 1st July 1995, 1 by 4th of the machinery installed on 1st January 1993 became obsolete and was sold for Rs 6,800. Show how the machinery account would appear in the books of the company for all the 3 years under diminishing balance method. Depreciation is to be provided at 10% per annum. So here first we have to prepare the working notes. Next we have to prepare machinery account. While calculating working note, we have to take only that part of the machinery which is put into sale. So let us start preparing working notes. Calculation of loss on sale of machinery. The cost of the machinery is 40,000, but at the time of the sale, only 1 by 4th of the machinery is sold. So 40,000 into 1 by 4, we will get 10,000. We have to calculate depreciation on this 10,000, which is 10,000 into 10 by 100, we will get 1000. Next, we have to subtract these two items. We will get 9,000. For next year, we have to calculate depreciation on these 9,000. So 9,000 into 10 by 100, we will get 900. And for the year 1st January 1995, we have to calculate depreciation on the amount 8,100, which has been got by subtracting 900 from 9,000. So while on 1st January 1995, we have got 8,100, and we have to note that the machine is sold on 1st July 1995, and so the machine is used only for 6 months. So we have to calculate 8,100 into 10 by 100 into 6 by 12, for which we will get 405 rupees. If we subtract these two items, we will get 7,695 rupees. The machine was sold for 6,800. So absolutely we can find out that the loss has been happened for 895 rupees. Next, we have to calculate machinery account. While calculating machinery account, we have to take the whole amount. While calculating working notes, we have to take only that part of the amount which is put into sale. But while calculating machinery account, we have to take the whole amount. So the first entry is on 1st January 1993 to bank account 40,000. We should not take 10,000, we must take 40,000. And at the same year, another machinery was purchased on 1st October 1993. So we have to write to bank account 20,000. In the credit side, we have to calculate depreciation for these two machineries. And in the question, it has been given that depreciation is calculated on 31st December every year. So for these two machineries, we have to calculate depreciation 40,000 into 10 by 100 and 20,000 into 10 by 100 into 3 by 12, because we have purchased the machinery on October and we are calculating depreciation on December. So there is only 3 months gap. We have to take into 3 by 12, for which we will get 4,500 in total. While calculating, absolutely we can say the debit side has the higher balance. So credit side we will get 50,500 as balance carried down. For the next year on 1st January 1994, we have to bring down that balance. We will get 55,500. On the same year, another machinery was purchased for 10,000. At the credit side, we have to calculate depreciation for these two machines, and for the second machine, we have to write into 6 by 12 because we have bought the machine on July. So we have to calculate the balance. The balance carried down is happening to be 59,450. We have to bring down that 59,450 to next year on 1st January 1995. This year we have to make calculation at utmost care because we have made sale on this year. As I said earlier, the sale has occurred on this year. So on the credit side, we have to write by bank sale, because when the sale is made, we will make the journal entry as bank account debtor to machinery account. So in the machinery account, credit side, we have to write by bank 6,800, and depreciation at the time of sale was 405 rupees. So by depreciation 405. By profit and loss account, loss on sale. Loss on sale we have to write on credit side. If there is a profit on sale, we have to write on debit side. Here it is loss on sale. So we should write on credit side, which is 895 rupees. This is only for the machinery which is sold. So for remaining machinery, what we have to do is 6,800 plus 405 plus 895. We have to add all this amount and we have to subtract it from the balance of 59,450. So we will get 51,350, for which we have to calculate depreciation at 10%. We will get 5,135, and if we calculate the balance, we will get 46,215. By this, we come to the end of this sum. Let us discuss a sum on annuity method. A firm purchases a 5 years lease for rupees 80,000 on 1st January. It decides to write off depreciation on the annuity method, presuming the rate of interest to be 5% per annum. The annuity table shows that a sum of rupees 18,478 should be written off every year. Show the lease account for 5 years. Calculations ought to be made to the nearest rupee. So here a firm purchases a lease for 5 years for rupees 80,000, and they have given the depreciation value also 18,478, and the rate of interest is calculated at 5% per annum, and we have to calculate lease account. Firstly, we have to take the amount of So firstly, when a FIM is purchased, the journal entry is FIM account debtor to cash. So in the debit side, we have to write to cash, the amount is 80,000. The credit side, we have to write December 31st by depreciation. By depreciation, they have given the depreciation value 18,478. And again, the debit side, we have to calculate the interest on the amount given. Here the given amount is 80,000. This 80,000, we have to calculate the rate of interest at 5%. So 80,000 into 5 by 100, we will get 4,000. And we have to see the balance, and we have to bring the balance down to the second year. Like this, we have to prepare for 5 years. Here we have to mainly note that the depreciation amount will not change for all the 5 years, but the interest will change for each year. Each year we have to calculate the rate of interest from the balance amount that is carried down, that is brought forward. Here in the second year, the balance amount is 65,522. At this amount we have to calculate 5% per annum, for which again we will get the balance of 50,320. This amount we have to bring forward to the third year. Again, the credit side we have tried by depreciation 18,478, and we have to calculate depreciation on this amount 50,320. We will get 2,516, and again we will get the balance of 34,358. Like this we have to proceed till fifth year. At the fifth year, we will get to see both the debit side and credit side tallying with each other. So if they tally with each other, we can find that the answer is correct. Thank you everyone for patiently listening to the presentation.